Thank you. Thank you, PMS and AIF. Thank you for having us here, giving this great opportunity to talk to you. You already heard all my colleagues who have been great in generating alpha, and maybe I'll cover a little bit of that also in the next 20 minutes that I speak. But I thought I will spend 10 minutes on two more important things. I believe we fund managers are the third most important people in generating wealth for you. Before that, there are two more important aspects which are important, and I thought I'll give 10 minutes for that to help yourself create wealth for yourself and the friends and the colleagues whom you advise. So basically 3 parts to the presentation. As I said, wealth creation is a non-linear journey, unfortunately, and more recently in the month of October, we had enough and more chaos in the market, even in November, and people had so many questions, and I'll show you a little bit in time that what you've seen is not even the fraction of what we have seen in the past 24 years that I have been in the career. So, a lot of discussion around corrections, so I will cover that. A little bit on alpha and beta, and then we'll come to alpha. But I think if in last 25 years, one key takeaway that I have is there are 2 constants in the market. One is wealth creation, which we all know. Wealth creation is beta, wealth creation has got alpha. But the volatility, the market corrections. I've seen many scared faces in last 2 months. I thought I'll just give you a flavor of what sort of corrections. We haven't seen any of this in the last 2 months, what we have seen in the past. But there was a phase where people have forgotten this, but over the last 25 years, 1 crore has become 25 crore. We all know now that equity is a good asset class and it creates wealth. Unfortunately, we have sort of forgotten because since 22, we haven't seen a decent correction in the marketplace. But when I go back into the history in the good times and the bad times, and when I'm saying even in the good times, that's in the April 2006. This was in the bits of a bull market that we had a 26% it's 32% correction in the middle of a 2004 to 2007 bull market. So it's very important that we don't forget that the second nature of market is correction, right? You will not create wealth in the long run without facing such. When we go back into the history over 34 years, and no fund managers will be able to protect you through this. That's also another thing. Let me be very upfront. At least the long-only fund managers are not meant to do it. And to that extent, you will have to have your own game plan for these corrections, these journeys, is what I'm telling you upfront. But we used to have fairly good frequent 20% corrections, but since October 20, we haven't seen one. And even the 20% corrections have been fairly reduced since October 14, that we have a policy stability, political stability, and whatnot. But the 10% correction is very usual. And that also somewhat was missing. And we all started to, at some point of time, started thinking that we can have wealth creation without the corrections. I thought this is just a reminder to all of you, you have your game plans, be prepared for these corrections because these corrections are inherent part of the equity. So I thought I'll spend first 10 minutes on how you can help yourself in the entire wealth creation journey. So this was very, very unique that between June 22 and September 24, we didn't have a single 10% correction, whereas the history tells you that once in every 4 months to 5 months, on an average, market corrects 10%. So that was an amazing period, great period for the investors, and then investors started believing that you can create wealth in a debt way. The equity wealth can create it in a debt way without corrections. So that was a little bit of and good that that thing eventually now came, that 10% correction came in the month of October and November. Coming to fund managers, for us, even our multi-baggers would correct. So when you will see my portfolio, you will see my colleagues, my other fund managers' portfolios, you will have some stocks which would correct a lot. This is one of the bluest of the blue chip IT company, which is 14x in 20 years, has corrected 50% once in a while and corrected 30% for so many times, has corrected 20% on a single day many a times. Then we go one step forward, bluest of the blue chip bank, which was like a bond. It was understood to be a bond at one point of time that just usme dal ke chhod do, you will beat every fund manager. That bluest of the blue chip bank, which is up 41x in 20 years, that has also seen massive corrections of 50%, but many of them being 20 to 30%, and had a most agonizing period of no wealth creation for 4 to 5 years, right? So even the best of the stocks would have corrections, both time correction and price corrections. I'm just saying this, be prepared when you're evaluating the markets, your own portfolio or the fund manager's portfolio. So that was one part, that we all want this, but we don't want this, but this is a package deal. We want wealth creation, but the time correction, price correction, pains in the market is a package deal. Just covering my last part on this is more recent correction. We all know market has corrected 10%. By end of October, it was down 8.2% from its 52-week high. Just to give you a flavor, what's happened actually in the marketplace. While the market is down 8.2% from a 52-week high, more than 50% of the Nifty 500 is down by more than 20%. Market has not corrected in October and November. Market has been correcting since election results. It's just that the Nifty was not correcting. And while 254 stocks are down more than 20%, 100 stocks are down more than 30% from their 52-week high. If that is any solace, what I'm trying to say is that market is already corrected a lot more than what the headline number is telling you, whichever way you want to interpret. That doesn't mean market will stop correcting, but just I'm telling you that the correction is far deeper than what the headline number is telling you. Moving on to the next part, which is the wealth creation. So hopefully this is well understood. On the wealth creation also, a lot of us would try and generate alpha. There is a beta part to it, which you need to understand. That again, very simple, price is equal to EPS into PE multiple. Your wealth generation comes from growth in the EPS, growth in the PE multiple. But at a market level and over a long period of time, PE multiple is not a big driver, so the big driver is EPS. And so interesting to see that that is also not linearly correlated to the economy. So if you watch economy and you believe, but it's that much will be the earnings growth rate, and that is also doesn't happen. So if you see, it's been a most agonizing period from 2008 or 2010 till 2020. While the economy did okay, the India Inc. did very badly. We are all surprised by the last 4 years of rally. चल क्यों रहा है इतना, market में इतना क्यों तेजी है? Why is it moving so much up? I think the reason behind that is the EPS part. The EPS part has been doing extremely well. If you see this, the left part is very, very stable. If we are growing 14% between 2010 and 2015, then we are growing 10%, then we have grown 10% last 4 years also. Look at what is happening on the right-hand side. This is the India Inc. for you. India Inc. grew its profit from 3 lakh crores to 4 lakh crores between 2010 and 2015. It grew from 4 lakh crores to 4.3 lakh crores between 2015 and 2020. And in the next 4 years, it's gone from 4.3 lakh crores to 14 lakh crores. So again, it's not linear, right? Over this 24-year period, economy has grown at 11.6%, EPS has grown by 11.8%, and market has grown by 11.6%. It's as simple over a 24-year period, but in between there are, and that reflects here in terms of various 5-year periods. They are agonizingly close, but not equal to what has been the EPS growth rate. So market is slave to earnings growth rate. And if we get this earnings cycle right, and then we will sort of get the market also right. But that's also very difficult to capture every time. That's where we come in, the alpha part. that what can we do better than the market. So you have to, one, survive the downturns, be prepared for the downturns, stay in the market through the market corrections. That's the first responsibility. The second is economy has to do well, and within while economy does well, India Inc. is to do well. So that is something which we keep on tracking very well, and that's when the fund manager comes in, which is in order to generate alpha. And here is where our philosophy, our thought process comes in, that at the end of the day, it is companies that create wealth, not markets. A lot of times we would love to discuss only markets and believe that that's the all thing we need to do. Unfortunately, that's not the fact, because while the economy does what it does, there are companies which are creating wealth and companies which are destroying wealth. These are rolling 5-year periods when you have winners and losers, but the interesting is this one. This is over a 16-year period. This is a very long period of time, and you would want to believe that over a 16-year, everybody will create wealth. On a NSE 500, you have 110 companies which have not created wealth over a 16-year period, right? And you have 130 companies which have generated more than 15% CAGR. This is where the fund manager steps in to identify and buy the top row and avoid the bottom row. And if you were to believe that one strategy fits all works, what we do and what is important at ICICI Prudential is to get all the three right. We need PAT growth, we need profit growth rate, we need ROEs, which is a quality, and we need the starting PE multiple, which is valuations. We are focused on all three. We need to get the growth right, the return on equity, which is the quality of earnings right, and we need to get the valuations also right. Because when we spoke about this, and we said that there's a delta EPS and delta PE, this is where the stock picking comes in. You have set of companies which may be very expensive, but they grow fast. Then there are a set of companies which will be not growing fast, but will be very cheap, on which you can make some money. And there are a set of companies which can have both delta EPS and delta PE, which is what is the painstaking work that the fund managers and my team has to do. Because this is what we are gunning for. Can we get both of this for our investors? And that's what we keep on trying to get. That can we identify companies which will grow earnings early on when their PE multiples are low, so that in next 5 years, 10 years, 15 years, we have both delta EPS and delta PE for our investors in our stock picking. And last but not least is how brutal the markets will be. Before 2020, this was the story. The B2C doing well, non-B2C doing badly. And the only game was to buy those Asian Paints and those HDFC banks and then the Kotaks and all that. There were only Hrithik stocks, and there were only few, the so-called 20, 30 companies were the only stocks to be bought in the marketplace, and everything else was junk. Surprise, surprise, next 4 years, those 20 stocks didn't perform and everything else in the market performed. So I think the ability of the fund manager, ability of an institution to continuously track the large spectrum of the market, that is where the large research capabilities into the company has helped us significantly, where we actually could participate in this and create a lot of alpha, because here we got a higher earnings growth rate in non-B2C, and we got the PE re-rating also. So it's a very important, that brings me to the last part, what we do, our approach. So as I said, we have a proprietary research. This is where we have a big strength. We have a 27-member research team, which keeps on identifying companies where we can get those elements of improving return on equity, a far higher earnings growth rate that we try to capture, with the longevity of idea, high quality of the business. This is what we call is boutique within an institution. Our big strength is here, research and funds management, with a very large risk, compliance, operations, and everything else, which are important part eventually to deliver the full package to the investors. But I think having a large research team which was tracking PSU banks, which was tracking metals, which was tracking industrials in 2020, when nobody bothered to look at them, the defense companies. And today we are tracking the FMCG, and we are tracking the IT, and we track a lot of sectors which are not performing in the marketplace today. So having the full breadth and having an eye on the all segments of the market at all points of time is what brings us a lot of edge as we keep on identifying businesses where we'll have both delta EPS and delta PE. We have been today at 35,000 crores on AUM and growing fast. I think we have invested a lot on all the capabilities within the alternates, and we'll continue to invest there. Just showing you a snapshot of what we have today. We have definitely a strong team here on the long only equity, on the private debt and the long short. You will hear Shekhar also during the day, who heads our private capital and debt team. And long short also is something, the capability we have built. Last 2 minutes, and I will leave a few thoughts for you and just try and summarize what I spoke. That while we have team, we have capability, we have ability, and we will continue to strive to generate alpha. But I think a lot of part of your wealth creation will be also your behavior, the investor behavior. And to make sure that you are playing right along with the fund manager, whichever alpha fund manager you choose to participate with, the same alpha fund manager will have his ups and downs, and he will generate alpha and he will not generate alpha at different points of time. But I think very important question for you to ask yourself: what are you? What is your game? What are you in it here for? Whether you are in a T20 or you are in test cricket. Because if you are in this markets for the T20, my belief, and PMS AIF can correct me, but I think you are in the wrong room. Because a lot of institutionalized wealth creation is all about staying invested, giving time to yourself, to your investors, anybody and everybody whom you advise, plus to the fund manager at this point of time. So I think the wealth creation will remain a test cricket as far as we are understanding the game. Second, once you are in the test cricket, then you need to have a patience. Nowadays, we don't have patience. The test cricket also gets over in 3 days nowadays. But I think ability to stay there for 5 days and watch every over, everything that matters, I think it's all about, not about excitement. So if you are in for an excitement, there are other places. It's been a very dangerous place to have all the excitement as we speak about. And last, I think the most important aspect of investment and most important aspect of wealth creation has to be our ability to survive the long term, and that comes from our ability to sleep well in the night. I think if the wealth creation journey doesn't allow you to sleep well in the night, then I think there's something wrong. We all along are always worried about investors, the returns, we are all worried about returns. What would be written now, today, tomorrow, yesterday? Unfortunately, that's in nobody's control. To stay in the game for a very long run, and that's the key. With the help of fund managers, it becomes better. But at the end of the day, this is something which you can control, and this is something which you should focus on. Unfortunately, returns is an outcome. It's not controllable, and to that extent, the sooner you understand, the better it is for you. So with that, thank you so much. I thought this 20 minutes I spent in making you a better investor, apart from obviously showcasing a little bit of what we can do for all of you. Thank you so much.